Lalit, morning. Thank you for joining us. Lalit, yes, budget chatter will dominate Indian markets this week. But what is your sense after the outcome of UP elections? Do you think life for finance minister has just gone, slightly tough?
Yeah, I completely agree with you. After this Congress performance in the UP, I think the power of the Congress has got emasculated. So it will be very difficult for the Congress now to push to the reforms in this coming budget. So there is a possibility that this budget might be not so exciting. It will be difficult, as I mentioned, and probably we will just see very accounting being discussed in this budget, and there might be a possibility that government might think about coming out with some proposal about cutting the subsidies, but whether it will get the final nod from its allied parties, I find it difficult. So altogether I am finding budget pretty unexciting. But at the same time, let me add this point that if you look at the current juncture of our current structure of our GDP growth rates, we are still cruising at 6.3, 6.4, growing at 6.4%. So by best, if you think a little bit of, if we just increase our activity on mineral fronts or on agriculture front, I think we can grow at 7.25%. So I think market is going to ignore this budget part, and probably we look at the inflation part, and the inflations are benign, then there is a possibility that RBI will speed up the process of cutting down the interest rates, which will take our GDP growth back to 7.25, and this is what the market participants are going to look into. So more or less, an unexciting budget is, I think, well accepted right now. People, it won't be if budget is not exciting, I don't think it will create a fall in the market.
Lalit, hi, morning. So after the CRR cut of 75 bips that we've seen on Friday evening, do you still expect that come Thursday and we may see a repo rate cut, or do you think the RBI is just going to give a course, or rather the commentary is just going to be on the future trajectory of interest rates rather than actually executing them?
See, this current CRR cut was because of, it was a compulsion for RBI because the liquidity was quite choked up. But having said that, I am optimistic, if not this time, but in the coming month, that RBI will take a very holistic view on what kind of inflation we are having. And I think barring oil prices, if you look at the prices of all the other commodities in agriculture and minerals, most of the prices, in most of the cases, the prices are down. So I think the inflations are going to be benign. The global GDP growth also is not going to grow at the level what was expected sometimes back. So RBI will take a very holistic view, and there's a possibility that they will cut down the rates, not this month, but in the April.
Lalit, every year we talk about importance of budget, and we think that every year budget will be make or break for Indian markets. But once the budget dust settles down and all the analysis is done and dusted, it's eventually global cues and earnings which will drive Indian markets. Do you think this time around also budget, even though everyone is expecting that it will be make or break in nature, in reality it is not more than a 100-point Nifty event?
Yeah, I totally agree with you that budgets, I don't think any major reforms are going to get announced. But yes, it can show up the sentiments if, for example, they open up the insurance sectors. So I personally agree with you that budget will not decide the trend. It will be basically the liquidity factors in the global market and what kind of GDP growth we can achieve. But at the same time, let me again put this point that I am expecting our GDP growth to improve significantly in the coming years. In the coming year, probably at 7.25. So if you look at the market, if GDP growth is around 7.25%, our corporate profits can again grow by 15-17%. So if you look at the valuation, currently it is only 13p. And looking at the liquidity in the global system, I think that probably because of all these factors, we might see market giving in 15-20% appreciation, but despite the fact that budget is not going to be exciting.
Let me construct two scenarios, and then you tell us that how markets will react to both these scenarios. Scenario number one, we get a very strong pro-market budget where there is emphasis on subsidy management, and government is very clear in how they will map and how they will manage their expenditure. What happens in that scenario number one? Scenario number two, we get a populist budget, fiscal deficit is out of the whack, government has taken a very so-called election approach, and there are a lot of subsidies which are being doled out. What will happen to markets in scenario two?
See, the first scenario which you mentioned, that the government will keep a tight leash on subsidies, which has now gone to 3% of the GDP, and as we all know that the fiscal deficit combined will be around 9.5% to 10%, which was which was the case in 2002-2003 times, and which put quite of liquidity crunch in the system. So definitely, if the governments announce reforms about to cut the subsidies, definitely there will be a big thumbs up on this front. There can be a big copious FIS inflow in our market, and probably our market, instead of trading at 13-14 PE band, it can trade at 16-17 PE band also, because the earning momentum is going to catch up once the interest rates comes down, and if a tight leash on the budget will definitely cheer up the sentiments, FI sentiments. So they will definitely market will go to 16-17 PE. Now in the second case, in case the governments, I don't think it will be very populist budget. Probably they are not going to cut down the subsidies, but I don't think they are going to increase the subsidies. In that kind of scenario, I think the market will then wait and look at the inflation numbers, and then look at the RBI policy, when will the interest will come down. So, but at the same time, I think our valuation band will get restricted to 13-14 P. But in both the cases, what I am seeing is that the earning momentum will now improve to 15-16%. So so the case one, probably we'll see a 30-40% rally in the market in 1 year duration, or otherwise if you mention that if it's a case 2, scenario 2, probably we have settled at for a 15-20% growth rate.
At Angel Stock Broking, I understand that you have a buy going on Axis Bank. Why is Axis Bank one of your top picks from the private banking space?
The reason is that if you look at the profitability ratios of Axis Bank within the private space, it is earning a 20 ROE, which is similar to what the HDFC Bank is earning. And if you compare it with the ICICI Bank, the ICICI will take some time to bring its ROE to 20. The ROE of ICICI is around 15-16. It will take some time for ICICI to go to 20. Now, if you look at the valuations of Axis Bank, it is trading at 1.6. Sorry, it is trading at 1.8 price to book value, and in terms of P, it is hardly trading at 10 P. And if you look at the capital adequacy ratio of HDFC Bank, of all the private sector banks, I think the capital adequacy ratio of Axis Bank is on a lower side. So this will be the first company which will again go for dilution infusion in the coming 1 or 2 years. So dilutions and infusions are always book value accretive. So post dilution, probably the stock is trading at 1.6 or 1.5 price to book value. And this stock usually takes at inline valuation to Sensex, and currently it is trading at 30-40% cheaper than Sensex valuation. That's the reason we like Axis Bank in this space.
In this calendar year, most of the asset owners, names like Lanco, GVK Power, JP Associates, they have appreciated by a good solid 80-100%. Is it too late to buy some of these asset owners or companies which have a high debt stroke, high gearing?
Though I am not having I have not tracked those companies which you have mentioned, but generally since we expect, everybody is expecting, and we also expect the interest rates to come down, so definitely those companies who are loaded with the debt, they are going to show better results. But having said that, I personally feel that one should be very discerning while picking up stocks from such space, because interest rates are not going to come down very significantly. Probably it will just nudge down by 100 or 150 basis points. So you need to be very careful. So I will advise investors to go for companies where there is a balance, where the management reputation is at management's integrity is not having any doubt, the balance sheets are clean. So some stocks which I will like to prefer will be, let's say, Mahindra Landscape in real estate, which is if you look at the market cap of this company is hardly 1300 crore and is trading at 1 time price to book value. But if you look at the potential in this industry, real estate, and the management's vision, I think this valuation is very cheap. It hardly just justice to the potential of the company.
Between Tata Motors and Tata Motors DVR, would you go for Tata Motor DVR because it is available at a P multiple of 4 times, dividend yield of about 3.5%, and it is trading at a 50% discount because it's a non-voting share to Tata Motors?
See, I'm expecting the cyclical businesses or interest-sensitive businesses, the sentiments to improve for this sector, for the automobile sector. So I'm expecting probably Tata Motors or automobile sector to get rated in the coming times. And this kind of scenario, what I generally say is that the valuation gap is expected to come down between these two companies. So definitely, if anybody is ready to invest hold on the stock for 1.5 to 2 years, I think this GDR will be better than owning Tata Motor. The gap, which is right now 50%, it might come down to 40% gap.
Right. So between Tata Motors and Maruti Lalit, which is a better stock to buy? Because they both have their set of arguments. For Tata Motors, the argument is it's a global business. For Maruti, the argument is it's a local business.
I think between the two, I'll go for Tata Motor, because Maruti is having still a market share of around 55% or 50%. I think in the coming times, it will be very difficult to hold to this market share. And also because now I am not expecting the volume growth to go back to 20-25%, which was the case in FY07 or 08. Probably the volume growth in the car sector will be around 15-16%. So at this point of time, so if the volume goes only 15-16%, and if you are expected to lose a market share, what it means that probably volume growth for you will be very mediocre. So I think probably at this juncture, I am better off. I think that investors are better off buying Tata Motor.